If you're looking at the UK property market in 2026, you're probably seeing some seriously mixed signals, right? On one side, you've got good news, stable rates, strong yields, but on the other, there are these stark warnings about hidden traps for pretty much everyone, from first-time buyers to seasoned investors.
And this is what I mean. On the surface, yeah, things look pretty decent. Rates have kind of settled down. There are over 7,100 mortgage deals to choose from, which is an 18-year high, by the way. And rental yields look really strong. But when you dig a little deeper, you start hearing phrases like macroeconomic mirage, sophisticated traps, and even deal killers. So what is the real story here? That's what we're going to figure out. We're going to unpack all of this and get to the reality behind those conflicting headlines. Okay, let's jump right in.
First off, let's talk about this idea of a market mirage, because that apparent stability everyone's talking about, well, it is so much more complicated than it looks.
You see, right now, lenders are in a full-on price war to get your business. But here's the catch. That optimism is incredibly fragile. Just look at what happened back in January of 2026. Inflation ticked up just a tiny bit and boom! Lenders like Nationwide and Santander pulled their best rates almost overnight. It just goes to show you how fast this market can shift. And this brings us to our first big trap. So many people assume that mortgage rates just follow the Bank of England's base rate. They don't. A better way to think about it is this. The base rate is like today's weather report, a snapshot in time. But swap rates? They're the long-range forecast. They're what lenders actually use to price their fixed-rate deals. This means that by the time you hear the good news about a rate cut, lenders have already baked that into their prices. And honestly, the best deals are probably already gone. Okay, next up, let's focus on first-time buyers. Because while there are some really exciting new ways to get onto the property ladder, they come with a whole new set of risks you've got to navigate.
0% deposit? I mean, that sounds amazing, right? For renters who have a solid history of paying on time, products like Skipton's track record mortgage have made this a reality. It's a total game changer. But, and this is a big but, it does not mean there are no upfront costs.
And here is a perfect example of one of those hidden costs, the stamp duty cliff edge. Remember, on April 1st, 2025, that tax-free threshold for first-time buyers dropped from £425,000 all the way back to £300,000. For anyone buying a starter home, especially in a more expensive area, this suddenly meant finding thousands of pounds in extra cash out of nowhere, and it's cash you can't just add to your mortgage. Then you've got this little thing called the high-income multiplier trap. A lender might offer you a mortgage of, say, 6 times your salary on paper. Sounds great. But because of new rules, their computer systems now dig deep into your actual bank statements. And all those hidden lifestyle costs, your subscriptions, insurance, student loan payments, they can trigger an automated computer says no rejection, even when you thought you were a shoo-in. All right, let's switch gears and talk about landlords. The new Renters' Rights Act, which kicked in during 2026, has completely rewritten the rulebook for anyone investing in buy-to-let properties. And to really get why, you need to understand this one term, the interest cover ratio, or ICR. It's basically the simple test lenders use. They ask, does the rent from this property cover the mortgage interest, even if we stress test it at a much higher rate? You see, the Renters' Rights Act caused a huge shift. It got rid of fixed-term tenancies and those Section 21 no-fault evictions, and it moved everyone onto rolling contracts. Now, for a lender, that takes a nice, predictable income stream and turns it into something much, much more volatile. So what did lenders do? This is the crucial bit. They brought in something called periodic loading. To cover their new risk, they've jacked up the typical ICR requirement from 125% all the way to 145%. The bottom line, a ton of properties that would have easily qualified for a mortgage in 2024 simply don't make the cut in 2026. And this has led to a nasty situation known as the mortgage prisoner effect. Imagine you're a landlord with great long-term tenants on older, lower rents. Well, now you can't pass these new, tougher ICR tests, so you're trapped. You're stuck with your current lender, completely unable to remortgage to a better deal. Okay, so beyond those specific traps for buyers and landlords, there are a few deal killers out there that can wreck any property transaction in 2026, and it doesn't matter who you are. Look, deals fall apart for all sorts of reasons. Mortgages get rejected, chains collapse, it happens. But there's one issue in particular that has become a huge problem recently. Get this, in late 2025, almost half of all UK property sales hit a down valuation. No joke, half.
That's when the mortgage surveyor comes in and says the property is actually worth less than the price you and the seller agreed on. And it's happening for a few reasons. A lot of sellers are just way too optimistic with their asking prices. Surveyors are flagging issues with the property's condition, and frankly, lenders are just being extra cautious in this economy. The result is always the same. Either the buyer has to magically find thousands of pounds in extra cash, or the whole deal just collapses. And finally, there's the ground rent gotcha, which is a massive headache for people with flats. In the past, loads of them were sold with these really aggressive ground rents. Now, there's a new law coming to cap them at a reasonable £250, but it's not law yet. This has created this weird interim trap where lenders are just flat out refusing to offer mortgages on these properties, making them basically unsellable for now. So, after all that, how on earth do you navigate this new normal? The trick isn't to think of the market as good or bad. It's just a new environment, and it has a completely different set of rules. And look, if you only take one thing away from all of this, let it be this. The 2026 market rewards preparation, not prediction. Trying to time the market perfectly is a fool's game. Being ready for its traps, that is the new key to success. So here's your playbook. If you're a first-time buyer, you need to budget for what I call deposit buffering. That's extra cash for those nasty surprises like stamp duty and down valuations. If you're a landlord, you absolutely have to stress test your properties against those new, higher ICRs. And for everybody, securing a mortgage offer a full 6 months in advance is your best defense against those sudden rate changes. Which really leaves us with one final thought. In a market that is so full of these hidden financial and legal traps, isn't the biggest risk of all just not knowing what you don't know?